Welcome, everyone. For those who don't know me personally, my name is Kyle Harris. I'm one of the plan consultants here with Two West Advisors, and I specialize on our not-for-profit side of the house. So I work with a lot of 403B, 401A plans, and always excited to see some of the committee members I work with and some of the fiduciaries join these sessions. But with us, if you've ever joined one of our sessions over the past couple of years, you probably recognize Bonnie Treichel. Uh, Bonnie is, I waved as if we hadn't been chatting this whole time, Bonnie. Bonnie is one of our favorite people to come on and do one of our sessions. She is probably one of the top ERISA attorneys in the country. In my line of industry, where I like to nerd out on retirement plans, Bonnie is famous. So always like to jump on and get a chance to host with you. And then today, Bonnie's going to go through and do one of our annual trainings. I'm responsible for the retirement plan. Now what? And it simply just means I'm a plan fiduciary. What do I need to know? And so with that, Bonnie, I'm going to turn it over to you and let us get started.
Awesome. Well, Kyle, now you've set the bar a little bit high. I would appreciate if we could lower the bar to like ease into this, but thank
That's
you for the warm welcome.
Yeah, no, that's your job to lower the bar. I'm just being honest.
We'll keep trying to increase or raise the bar. That'll be our goal. So thanks everyone for spending your time. I know this is a lot to ask an hour out of your busy day. Many of you are probably fiduciaries to the plan, but that's not your only job or duty with your respective organizations. So thanks for spending some time to go through a fiduciary training with Kyle and myself. Again, my name is Bonnie Treichel. I am an ERISA attorney, but I've also spent time working with plans directly. And so hopefully what you can see through this presentation and with Kyle's help is we'll really try to make things like here is the law or the rule, but here's how you can actually apply that in your practice. So we're really going to just go back to some of the basics, but some of the basics that actually have a lot of really direct applicability in what you're doing. So we're going to talk about some of just the basic terminology as it relates to retirement plans. We're going to talk about why we do fiduciary training. And then we're going to talk about who's an ERISA fiduciary, why does that matter? Why does that matter in your day-to-day positions when you're not acting as a fiduciary? And why do you care when you are? And finally, how can you protect yourself? So that's really the high level of what we're going to jump into today. I probably advanced the slides a bit too early because I like to jump in first with just why do we do fiduciary training? Why do we require that fiduciaries sit through at least 1 hour, really multiple hours of fiduciary training each year? As a best practice, the first reason to do fiduciary training is really to make sure that those who are acting in an ERISA fiduciary capacity actually understand what their job is. It sounds very simple, right? But we want people that if they're serving in this important capacity, this is different than if we are in Kyle's world, if he's working with a college or a university, there's a lot of different committees on campus, right? But not all those committees are as important or carry the same weight as being on the retirement plan committee or the investment committee. Because this is such a weighty obligation, we just want people to understand what they're signing up for. So if you're on the line today, we want you to understand this is what you've signed up for. These are your roles and responsibilities, and these are the things you want to watch out for. So reason number one to do training is just really to understand your duties and responsibilities. Item number two is litigation risk. And some of you might say, hey, we're never going to get sued. And you know what? You're probably right. You are probably not ever going to get sued. And I know this is being recorded, so I'll deny it if you're ever sued and you say that woman told me I wouldn't be sued. But the reality is, you probably won't be sued. But it's not impossible, particularly in light of the Cornell case that we had recently, and given that there are becoming more and more plaintiffs' firms, and it's moving down market. So I am 100% not a scare tactic type of attorney, but we do want to make sure that if in the event your plan becomes large enough someday, you understand that the reason to do fiduciary training is to have it in your file to be able to show, hey, I knew I was a fiduciary and I knew what I was doing and I took it seriously. You don't want to find yourself in the place of, if anyone remembers the NYU case a while ago, you had people who are on the retirement plan committee showing up at those meetings, and then they had to say they didn't actually know that they were a fiduciary when they squarely were acting as a fiduciary. That's a really embarrassing moment on the stand. And now in many kind of history lessons for years to come to be that person who says, I didn't realize I was a fiduciary, and you were clearly acting as one. And then the third and final reason is really similar to the litigation side. It's the Department of Labor, DOL, IRS, as well as then also even a little bit to some extent your auditors. You just want to be able to show your work, show you knew what you were doing by having some fiduciary training. So that's really why it's important not only to attend, but then to document that you've attended. If you don't document it, it's like you didn't do it at all. So you want to make sure that if you or others in your office attend live or listen to a recording, that you do put that in your file and you have evidence of the fact that you did it. You could even report it back to the committee at your next meeting and say, once 2 West sends out the materials, you get that certificate, report that back to the committee and put those in your meeting minutes. So what are we going to start with? This slide might seem like the most basic concept you've ever heard. Obviously, you all know that if you're the employer, you are the plan sponsor of the plan. I always include these basic concepts really as more of an indicator or a reminder that we want to keep in mind both within ourselves as like a retirement plan committee, retirement plan fiduciaries, but more so for our participants or our employees, that retirement plans are complicated. And they include all kinds of language that if you are not dealing with the plan, you don't know what this language means. You don't know what a QDIA means. You don't know all the different code sections like 408 and 404. And, that has no practical meaning to your employee who's trying to invest for their future. So I put this in as just a good reminder that we want to think in terms of simplicity, lack of acronyms, and explaining both to our others in the organization as well as to our participants. And so if we can do that throughout our fiduciary training with others in our organizations, as well as with our participants, that will be very helpful. So with that, I'm going to start with the framework with which plans are governed. But Kyle, anything that I'm missing before we jump in?
Actually, yeah, Bonnie, if you back up that one slide, I do have a question. I was thinking about this ahead of time. When you think of what to keep in mind with some of the terminology and being a fiduciary on that plan asset side, one of the things I'm seeing, and I think this is your favorite topic of lately, are the forfeiture accounts and the revenue credit accounts, and just kind of how important that is. So I didn't know if you wouldn't mind just sharing some thoughts there, because I'm having a lot of conversations this year on plans with, hey, what do we need to be thinking about with these plan assets that historically we really haven't paid close enough attention to, probably.
Yeah, I think, Kyle, you raise a really good point, which is being a fiduciary is hard. And so, where do we spend our time? Particularly on the investments, we spend our time where most of the money is, where the largest amount of plan assets are. So, I think all across many of the plans I work with, I don't see a lot of focus on things like the revenue credit account, some of these short term holding buckets, the forfeiture account. And we're not paying attention to number one, what is that money invested in when it sits in those accounts? Number two, if applicable, like in the forfeiture or revenue credit account, spending that money within an appropriate time. And I'll come back to that in a minute. And we're not paying attention to just always tracking all the dollars in and out of those accounts. I'll give an example of the latter first. So I was working with a plan sponsor here recently, and back 3 years ago when they did a transition, the forfeiture money never got set back up appropriately. And so they started pulling the advisor's fees, which service provider fees can come from forfeitures, but they started pulling it from some other account that was not the appropriate account. It should have been pulled. They were pulling it from the uncashed checks bucket, not the appropriate account for advisor compensation to be pulled from, right? But no one caught it. So this goes on for a while before anyone catches it. So again, number one, be thinking about just monitoring the money in and out of these various, I'm going to call it holdings accounts, because they are, as Kyle pointed out, plan assets. And so fiduciaries are responsible for all the plan assets, no matter how large or small that bucket of money is. Now, the second point that Kyle, you pointed out was, how can you spend that money? We could do a whole nother session on this, but the source of many questions because of recent litigation has been around forfeitures. So forfeitures are an issue where if you have a vesting schedule then usually you're going to end up with forfeitures that build up over time, right? So if you have no vesting schedule, this probably isn't going to apply to you very much. But if you've got a vesting schedule, you're probably going to have a forfeiture bucket. So you've got to be paying attention to the IRS guidance that tells you how how long you have to get the money spent down out of that forfeiture bucket, which a general rule of thumb to keep it easy is just spend it within a year, or otherwise stated, technically the year after the year in which it was generated, but just continually spend that within a year. And Kyle, feel free to chime in if you have a different thought on how to keep track of that. But it's like, if you just follow that year rule, it keeps it pretty easy.
Yep, no, I would agree. I think all of the plans we work with that are in that habit, it's almost just, it's a cycle that, hey, this is our May meeting. This will be on the agenda no matter what. And so,
Yep. And that's a great way to do it, is you've got that in your fiduciary calendar. And that's a great benefit of working with you, is to keep that on that fiduciary calendar. So it's not only the timing though, but then it's how can you spend it? So traditionally, the IRS has said you can spend forfeitures to reduce your employer contribution. You could give the money back to participants, or you could use it to pay plan expenses. But in doing so, you need to make sure you do it in a way that is consistent with your plan document. The source of the litigation has been over, essentially, are you putting fiduciaries, and again, we'll talk about wearing the fiduciary hat in a bit, but are you putting fiduciaries in a place where they would be making a decision that is in the best interest of the company and not in the best interest of participants? So again, we'll come back to this, but I think that's something to keep in mind, is you want to make sure fiduciaries are putting participants first. And so on the forfeiture cases, if you make this as a company decision, it takes that away from a discretionary decision of fiduciaries to breach that duty of loyalty. Anything else we want to cover there?
no, I think that was perfect. Thank you.
And folks, this might be the most comical because Kyle did not run his questions by me. So he might trip me up on some. So that
I'll do my
everyone's got
best
to
not to, but I can't make any promises.
stay tuned through the end so that we can see how this unfolds. So, one of the questions that I get with retirement plans is, oh, we're an ERISA covered plan. That's all we have to do. And it's like, wait a second, we actually have two sides that we have to think about. We have the ERISA side, and then we have the tax code side. So, one of the things that I'll say about this webinar is I'm doing all of this from the focus of ERISA covered plans. If you are listening in and you are a non-ERISA covered plan, most of the state laws or local laws that apply are going to actually likely track ERISA pretty closely. But even if ERISA doesn't apply, you still have to follow the tax code. So you still have to be concerned. It's not like, oh, wash my hands, no rules apply. You still have to be concerned with the tax code and the IRS. So keep that in mind. So we've got two sides that we have to follow. We have ERISA, which was passed in 1974. And again, it was passed. So thinking about the spirit behind this, we're doing something to protect employees as they are making contributions that really you as the fiduciary or employer are taking actions on the behalf of your employees. So you've got this heightened duty because you're protecting their retirement nest egg. And so that's where this thought process behind ERISA comes from. ERISA is our high level infrastructure, I'm going to say, or framework. And then under that piece of legislation, we have subsequent, what I'm going to call regulations that come from the Department of Labor and Employee Benefit Security Administration, or EBSA. And then underneath that, we get additional guidance. So this is why it's so important to work with folks like Kyle, because you're not probably tracking along every time the DOL or EBSA sends out like an FAQ or a field assistance bulletin. But there is this patchwork of different, I'm going to call it, you've got regulation and compliance assistance releases and all these different things that come out that you actually need to keep track of for your ERISA compliance. And so keeping that patchwork in mind, it's all underneath the framework of ERISA enforced by the DOL. On the other side of things, you have the tax code. And so the tax code is, or the Internal Revenue Code, tax code for short, that's enforced by the IRS. On that side, what we're really concerned about is, are you operating your plan in line with the plan document? On the DOL side, we're we'll talk about that more, but that's really all about breach of fiduciary duty and such. But on the tax code side, it's where's your plan document? Because we need to make sure you're operating in line with that plan document. Now, just like what I talked about on the DOL side, same thing happens on the IRS side and from Treasury. We get, we've got our tax code, and then it can be updated. We have regulations that come out. And then there's other guidance that comes out that's interpretive in nature, things like the EPGARS program and the revenue procedure. Again, these are additional interpretations for how we run our plans that's coming from the IRS. So we just want to be mindful of these two frameworks, which sometimes intersect and have very similar language, but also have very different rules that we have to follow so that we operate our plan in line with the plan document, so that we, for example, we pass our compliance testing and we don't discriminate against our non-highlies, for example, and that's on the tax code as well. So Kyle, anything I missed there that we want to add on before we move to the next part?
No, I don't think there's anything you missed. I do have a question, and you can tell me, just take this offline, because this is more just personal question I thought of. We've got ERISA on one side in Department of Labor, we've got the code on the other side. When we see all the regulation and these regulatory changes, Secure Acts, CARES Acts, or do you see either one, either Department of Labor or IRS, being more or less of a roadblock for those changes to actually see the light of day? I know we see a lot of things that come out, and then we get the pauses, the holds, the waits, and it's very hard as a fiduciary, because we talk about it and then we stop it
So
and bring it back up.
yeah, so Kyle's actually bringing up a really good question and the practical side of how this works in real life, right? So you brought up the example of three things we've seen over the last, since 2019, so over the last 6 years. So we had the first Secure Act, then we had CARES Act, then the second Secure Act. And I'd always describe those as like they're a framework. They're this high piece of legislation, but they don't actually tell you how to do the things, right? So if you think of like the student loan matching provision, or if you think of the Roth catch-up provision, Roth catch-up's probably a better one, actually. So the Roth catch-up, which totally unrelated, but action item for everyone listening, make sure you're ready for Roth catch-up as of 1/1/26. If you're not, just put that on your post-it note by your computer right now, because again, it came out in Secure 2.0 at the end of 2022 and said that if you have employees who make over $145,000 in the prior year, they're going to have their catch-ups as Roth going forward. But what that didn't tell us is all the details for how this actually has to work, right? Like if you actually tried as an employer to go and implement that, or a payroll provider or record keeper, you wouldn't be able to, or even a CPA to really apply it. So then we have to have the guidance coming from the IRS in this case that says, hey, this is how this works. So we first got from the IRS a grab bag of guidance that gave us a little more detail, but that still wasn't enough. And so they pushed it back to start 1/1/24 to 1/1/26. And then we're now waiting on a proposed regulation to become finalized, again, to still further understand how it works. So Kyle, I'm going to let you answer the question, but I just described like three additional things that had to happen for one of 92 provisions to actually start. Roadblock, not roadblock. I think it depends on if it's a provision you like or not, if we want to call it an opportunity or a challenge. But I do think that some of these, we get a framework, but we have to like have the additional guidance for it to actually happen. And that's where it gets challenging for fiduciaries.
Yeah, no, I think you summed it up really well. The whole, looking at it from a framework, because it is, it's not a one-time conversation when these things come up and they roll out new legislation. And so I do see it, whether it's a good, bad, or indifferent, some of these changes where we start up and we start working as fiduciaries, and then we just pause and we sit, and as we're waiting, we forget everything we learned the first time around. So, but more poking fun at who should I be angrier at when that happens, IRS or DOL? But no, I think
It
you
happens on
framed it
both.
very nice. Yeah.
It's coming from both sides of the house, but I do think it reinforces maybe a couple of action items. One, make sure you're working with good partners, everything from your, advisor at 2 West to the right record keeper, a TPA if you have one. your payroll provider, because all of those folks have to work together as this myriad of changes happens. And then two, you've got to be set up to be flexible enough to adapt as these changes happen. So you might set up your payroll file one way, but if we get last minute guidance for this Roth catch-up provision, you still have to be prepared to comply in time and be adaptable to move with those new changes.
Yeah, no, that's a really good call out on the provider side. Cool. I promise I'll let you keep moving.
No, this is fantastic because this is the real application of it. So in terms of then, where are we headed next with the conversation? We want to make sure that everyone is clear of ERISA fiduciary status. And then what we'll talk about is why you care. Well, you care for two reasons. One, you need to know what duties you're required to do or follow. And two, you need to also make sure that there's certain things you're not allowed to do called prohibited transactions. If you're not wearing that fiduciary hat, you don't have to be concerned about prohibited transactions. But once you put on the fiduciary hat, there's certain things you have to do under Section 404 of ERISA, and there's certain things you're not allowed to do under Section 406 of ERISA. So how do you know if you're an ERISA fiduciary? Well, Kyle, for example, is an ERISA fiduciary to most of you because he gives you investment advice and he gets paid money. So by giving advice for a fee, that makes someone an ERISA fiduciary. Now, the one thing I should mention, both with item 2, talking about Kyle or 2 West, as well as for any of these others, you actually are not allowed to give yourself a different title or write down that you're not a fiduciary and make yourself not a fiduciary. Unfortunately, the Labor Department doesn't care what you call yourself. They look at what you do. So it's all about this functional aspect, not out-titling ERISA fiduciary status. So how do you as a plan sponsor or employer become a fiduciary? There's two ways that you become a fiduciary. And in plain English, what they mean is you use your brain, your judgment, for example, or discretion, and you can either spend the plan's money, and that means investing it too, or alternatively, you decide how to run the plan. You decide how to manage the plan or how to spend the money, how to have discretion or responsibility over what's happening with the plan. If you're using your judgment to do those things, you're going to become an ERISA fiduciary. Now, there's a distinction in something that we should make, and I'll make that distinction, and we'll do it in kind of two different capacities. One, you're not a fiduciary if you're doing purely what I'm going to call administrative or ministerial duties. So we'll make that distinction of if you're doing something by not using your judgment, you're just executing, then that's administrative in nature. You're not going to be a fiduciary. Also, if you are acting in a business capacity or for the business, then that is not fiduciary in nature. So some of you might have heard that term before. It's called the settler function. So the settler function is this notion that if you are doing things like deciding on starting the plan, terminating the plan, deciding on plan design, if you think back to COVID, I'm guessing many of you had to make decisions about like, oh goodness, are we going to reduce our employer match? Are we going to cut our, match altogether for a period of time? Whatever it is, you probably had to make some plan design types decisions. Are we going to have loans for our plan? Many of these Secure 2.0 provisions, those are all plan design. Those are business. Those are not made with your fiduciary hat. Those are made with your settler or business hat. They could cost the business money. You can make those in the best interest of the company, and those do not carry with them personal liability. Contrast that with fiduciary decisions, which have to be made in the best interest of participants. And those are those decisions where, again, you're using your discretion, you're using your judgment, and you're acting on behalf of participants. So we've got a couple of examples, but Kyle, you might have a few other questions or examples to kind of demonstrate this point. But one that I always make a really good example of is going back to my point about if it's purely administrative in nature, that's not going to be fiduciary. So for example, our payroll person, payroll manager, for example, that is purely transmitting, just sending in, pushing the button every week, every 2 weeks, pushing the button. That is not fiduciary. Now, if our same payroll manager, getting wiser, following up, looking at the plan document and saying, wait a second, I think bonuses are a big issue with comp, right? I think bonuses should be included in this calculation for compensation. I'm going to start including that. Our payroll manager has now put on what kind of a hat? A fiduciary hat in using that judgment or discretion. And so we want to just distinguish some of these different roles and responsibilities based on the function that they're performing. Other examples of this are, again, it doesn't matter the title, the CFO who is signing the Form 5500, that's going to be fiduciary in nature. Keep in mind, you're not just signing, you should actually be taking a look at that Form 5500. The business owner who's selecting the record keeper and the advisor, if they're getting paid out of plan assets, you're selecting, you're monitoring, that's going to be fiduciary in nature. Kyle, any questions that we have or any thoughts that we should share?
I think you might answer a few of these on the next couple slides. But one thing I have in the back of my mind as you do go through is we probably have a lot of folks on here who sit as part of a retirement committee or investment committee. And they may look at this and say, well, I sit somewhere between that payroll manager and that CFO title. And I think you said it perfectly just now. It's less about the title and more about the action that you're taking on the plan. So I don't know if you have any thoughts on how you would frame that up for, that faculty or staff representation that's sitting on a committee that is part of that decision-making process.
I think that's a great question. So you bring up a really good point, which is really this distinction about once you put on a fiduciary hat, that doesn't mean you are always acting as a fiduciary, right? So you could have a fiduciary hat on when you're in the committee, because I bet in your committee meetings, you're doing what? You might be voting on investment options. You might be voting to keep Kyle around and not kick him out, right? You might be doing these various activities. You would never kick out Kyle. But you might be doing these various activities. And so you're wearing your fiduciary hat when you're in those fiduciary committee meetings. You could also be doing things outside of the committee meeting that might not be fiduciary in nature. You might have a couple of different tasks that you do, they're purely administrative. Maybe another fiduciary is directing you to, but your role in that capacity is purely administrative. So there can be different hats that you wear at different times, just like our CFO who can put on a business hat and then separately put on a fiduciary hat. Those hats can come on and off. But to your point, I think the safest practice is to, when in doubt, if you think you're a fiduciary, you probably are a fiduciary and should follow the rules on the fiduciary side, or clarify in writing very clearly, document when you are acting with that like settler business hat. If you're not sure which side it's on, if you've got documentation, that's certainly going to help to demonstrate that was an opportunity to act as a settler or business function, not in a fiduciary capacity. But again, you can't just always write down, I'm acting as a fiduciary, I'm acting as a non-fiduciary, even when it's clearly a fiduciary activity.
Yeah. Well, that makes sense.
So one thing maybe before we leave that topic is I get this a lot, like I'm in the committee meeting, the topic of should we add the secure 2.0 provision comes up. Do we have to adjourn the meeting and start the meeting again to decide for the business, should we add the student loan matching provision? No, yes, maybe technically you should, but I think there's some practical ways to say things like the business decided X and reported to the committee to do that, and the committee will execute on that. And you just put that into the minutes or meeting notes.
And I was just gonna say, and then you document. So documentation, I think, is going to be a theme throughout this conversation.
I'm like a broken record. So yeah, I think that can be very helpful for people. So once you know that you're a fiduciary, and the other thing I should have mentioned is don't forget, if folks have questions on any of these or their own examples that they want to throw in, please don't hesitate to use the Q&A. We've got that up as well, so feel free to use that Q&A feature too. So once you know that you are a fiduciary, again, we went back to there's a couple of reasons you care. One reason you care is because you need to know what you're required to do. So for all of you who spend your evenings reading ERISA Section 404, there are a couple of obligations that attach. The first thing you have to do if you're a fiduciary, and we talked about this a little at the beginning in reference to the forfeiture cases, is this idea of acting solely in the interest of plan participants and their beneficiaries, and with the exclusive purpose of providing benefits to them. Now, there's been some various court cases and questions over time about what that means, but the general idea here is that you are trying to do what's in the best financial interest of plan participants and their beneficiaries, and you make all decisions on that basis. One thing that can be very difficult is you say, well, I've got 300 participants, lady. How am I going to do what's best for all 300 people? One person's 60, another person's 25, and another person's 40, and they all have different needs. They all have different risk tolerances. How am I going to do what's best for everyone? I recognize that issue, but again, back to the documentation piece, what we're looking for is how can we do the most good for the most people in our plan based on our participant population. So we do this with all the different features and things in the plan. How can we do the most good for the most people? So what that doesn't mean is if we have a committee that is only made up of the C-suite, and the C-suite wants a brokerage window, for example, and I'm not anti-brokerage window, this is just an easy example. But if the C-suite wants a brokerage window, but then everyone else would be what we would consider maybe less sophisticated investors that a brokerage window wouldn't be appropriate for, and maybe it also has high fees, should we add a brokerage window? The answer would be no, because even though the C-suite all wants that and they're the committee members, they need to look at our participant population as a whole and not just what those couple of people in the committee room want and need. It's about our overall participant population. And I think that can be hard. You've got to set your own interests at the door when you walk into the fiduciary space or the committee room, and then you can pick it back up when you leave. But in that capacity, you're doing what's best for everyone as a group. The next duty we have is the one that I think can be confusing along with item 5, which is carry out duties prudently. Well, what does that mean? The idea here is that you are held to this like prudent expert standard. And so a couple of concepts, and we can talk about some of this more in detail, is that you should follow a prudent process. This is the requirement, the duty of care that you owe to participants. So you should have a process for everything you do as a fiduciary. You're required, for example, to have internal controls, and you're required for that on the DOL and IRS side. The idea here is I break it down into 5 steps. And again, we can talk more about this, but we want to have this framework for conducting all of our decision making. One of the ways that we can do that is in our investment decision making. Another is if we're selecting service providers. And again, we can come back to that here in a minute. But I think we just want to keep in mind we need a process. And again, documenting that process because it's like it never happened otherwise. The third item is an easy one. Well, maybe easier said than done, but following the plan documents, unless it would be inconsistent with ERISA to do so. That's back to one of the basic concepts we talked about at the beginning. You need to follow your plan document. An action item from this discussion could be that you should make sure you know where your plan document is and that you have a plan document that includes all of the amendments. If it's from a provider, it's probably a base plan document and an adoption agreement. So you want to have both of those components, along with making sure you've got your amendments, that they are signed, and that they are dated. The fourth one is diversifying plan investments. And again, this is a good opportunity to point out that ERISA does not expect that you become a retirement plan expert. In fact, it specifically contemplates that you're not going to become, as a plan sponsor, an expert in investing or in retirement plans. What it does contemplate is that you either have the internal expertise and bandwidth to do something, or alternatively, that you go and hire someone to do that for you. The most common place that this happens, right, is with things like investments. Most folks don't feel like they have the expertise to go and, from an investment perspective, do the prudent selection, monitoring, and replacement over time, because that is an ongoing duty. So that's why they go out and hire someone like Kyle and his team to really help with that process. And then fifth and finally is the last one, paying only reasonable plan expenses. And again, this one can be difficult for folks because reasonable plan expenses, what is reasonable? Well, There's a variety of things we could talk about. We've got another slide on this we can talk more about, but it's about having, again, that process where you are over time looking at fees, paying what's reasonable based on the market rate from similarly situated plans, based on the number of participants, size based on plan assets, and then coming up with, hey, this is what we need from a service and value perspective, and we'll pay for that accordingly. All right, Kyle, I unpacked a lot of duties there. What did I miss?
I don't know that you missed anything. And the questions I had jotted down before was one of the ones I shared earlier where I'm like, oh, I've got some questions. And then I turn the page. And it's a perfect segue, I think, into you for some of those questions to consider based on these 5 core responsibilities.
Perfect. One of the things I like about ERISA is it gives an opportunity for open-ended questions. And so I think, based on the discussion that we just had on the prior slide, I use open-ended questions for committee discussions, for discussions with service providers, and it really helps as a good jumpstart to not have checklists in your file where you don't check off things, but instead to say, hey, we discussed these open-ended questions, and here's some meeting notes or considerations accordingly. So if you're thinking about obligations of an ERISA fiduciary, some of the questions you may be considering internally, or you might take back and talk about with your team is, do I have the expertise to make the decision, or should I hire someone? And again, I would extend that not only the expertise, but do I also have the bandwidth? So do I have the time? Do I have the experience? Do I have the expertise to be able to do this? Or does someone internally on my team, can they do that? If not, I need to consider hiring someone to do this. Another thing we want to be thinking about when we're thinking in terms of like prudent process is, have I objectively compared all the relevant information? And one of the things under ERISA is it's all relevant information that you should know about. And that can be difficult sometimes, right? Because you're like, hey, I'm held to a standard of I should know about things, but what if I don't know about things? Well, here it's all about, but even if you don't know, you're held to a level of expertise where you should know certain things. And so you should know enough to know what you don't know, which I know doesn't seem to make sense, but that's about learning enough to know what you need to know, or else hire an expert who will know that. Other things that you may want to consider, right, is do I need to meet with anyone else before I make this decision? Again, that goes back to knowing the relevant information, making sure you're working with experts if you don't. And then, of course, documentation and revisiting that decision over time. These are the types of questions that can help get you to what I would call a prudent framework for decision making, which would be based around things like, if we're in the investment side, I would call that your investment policy statement is step 1, which is develop your framework. Step 2 is go and collect information. Step 3 would be to objectively compare that information, like your qualitative and quantitative factors that you're looking at for investments. Step 4, you would select, your large cap growth fund, for example. And step 5, you're going to document that and then revisit over time. And that would be an example of a prudent process. One of the things we've talked about today is like, here's 5 main things you have to do as a fiduciary. This slide gives you, if you were to zoom in on it, there's tons of little responsibilities. It's not about reading the words on the slide, but it's about helping you think through, as Kyle mentioned, having kind of that every May look at forfeitures or revenue credit accounts. It's about coming up with a way to do a couple of things. Number 1, figure out how to track your ongoing fiduciary obligations. I shared 5 things you have to do as an ERISA fiduciary. Unfortunately, there are way more things you have to do and keep track of as an ERISA fiduciary. So what we wanted to do is give you an idea of like, hey, what are types of ways you could organize information? One of the things you could do is break it into different categories. You have your service provider category, your ops and admin, your investments, your employee piece. So you could break it down and then you could use that to assign roles and responsibilities internally. That's one way to start to think about that. So it's not only like, what am I responsible for? But number 2, you also have to be tracking, how am I going to keep track of these updates? Back to where we started our presentation with DOL, IRS, we've got these laws, but then we keep getting more guidance over time. It just adds to the list. Like, how many of you thought about missing participants 10 years ago and uncashed checks? Or how many of you thought about like paying attention to cybersecurity 15 years ago? Some of you might have. I don't think it was a high priority, except until what happened in 2021. We got some guidance and the Department of Labor started adding it to their examination list, right? That starts to increase the focus and we add it to our list. So again, you can organize this in any way you want, but you have to have a process for paying attention to this over time and following back up on it. In our remaining time, we've talked about what it means to become a fiduciary. We've talked about your duties once you are a fiduciary. One of the things we've talked about is that ERISA does not require you to do it all. You can go out and should hire experts when you don't have the requisite expertise or time to do something. That being said, let's think about hiring people. One of the things when we're hiring folks is that you are probably at the outset of an engagement getting an agreement or a service contract, for example. So you probably have some sort of process where you're onboarding Kyle or a record keeper or an auditor, all of these people, you onboard them as a new vendor in your system. One of the things from the ERISA perspective that you have to be cautious about is this idea of what I'm going to call 408b2. Most of the time, your 408b2, which is the regulation it came from, it is going to be part of what's called like your service agreement or your contract. This is all a big fancy way of saying you have a duty to understand for each of your service providers who's paid $1,000 or more out of plan assets within a year. You need to understand, are they acting as a fiduciary to you as the plan sponsor or participants? 2, how much are they paid? And 3, what are the services they perform? You need to get that upfront, and anytime any of those 3 things change. You also need to review that agreement or those 3 things in terms of, hey, is this reasonable? Am I getting value out of this? And I'll let Kyle talk a little bit about maybe benchmarking here in a minute and how they look at reasonableness of fees. But that's part of your big duties, right? Is get this 408b2 disclosure or agreement, put it in my file, but review it for reasonableness of fees. And then also make sure you're looking for conflicts of interest and make sure that you can either have a method to mitigate those conflicts, get comfortable with those conflicts, or not work with that service provider. So that's really your ongoing duty, both initially and every time there's a change for any one of those service providers. Kyle, do you want to talk about your process for determining fee reasonableness?
Sure. Yeah. And I recognize a lot of names on here, and I would assume most folks attending today are working with 2 West in some capacity as a fiduciary. So maybe you've seen it before, but we try to go out there and we want to benchmark no less than 3 years. And that's where we're really collecting plan data from the retirement plan that we're working on. So if we're assigned as that ERISA investment manager, that fiduciary, we're going out there and we're saying, okay, we know what the plan looks like and we know what the fees are. That's easy to see. But instead of saying it looks good, we're going to take that and we're going to go to third parties and actually benchmark it. And we're going to be very specific to look at similar size plans and similar size industries or similar industries so that we can see, okay, we're happy. We like who our providers are, and we're not doing this because we're looking for change, but we do want to make sure that we can, again, go through that process and then document the work that we're doing. And so if we go back and look in our fiduciary files for any of the plans we work with, we can usually pull up within the last 3 years, oh, this is what we did the last time. And typically we're going to follow that same process. Of course, Bonnie, unless there's some sort of circumstance that says, hey, we have a lot of pain. We're not going to wait that long, or we're going to break the chain and we're going to do something a little more robust that might require some RFPs and some RFIs, where we're really going to start digging in. And I'm not sure, Bonnie, if that's what you were looking for, but I know it's for a lot of the 403B plans this year, that's a big effort we're doing because it's time for us to check that benchmarking box.
Yeah, I was going to say that's something I get a question a lot. Like, well, do you have to benchmark every year? Do you have to do an RFP every 3 years? There's no set rule under ERISA that you must do either of those activities at a set interval. It's really about coming up with a best practice to document what works for your plan, to be able to show you're paying attention to fees, you're negotiating fees where you need to, and that you're inquiring upon the way. It is not a set formula for every plan. There's been a variety of cases that have come to different outcomes based on different facts and circumstances.
Yeah, and I also think we've seen a lot of merger and acquisitions or consolidation, and that is always a time where even if we just did it in the past year, the foundation or the fundamentals are really changing. The economics are probably changing, and so we'll usually go ahead and pick up right where we left off, even within the past year, and say, okay, let's start this over because the plan is going to look a whole lot different today than it did yesterday.
The plan's going to look, and so the M&A goes both ways, right? It's M&A with the plan that can create changes, and M&A with any of your providers too, because it's a whole new service provider, so that can create
Yeah,
changes too.
yeah. Sometimes you'll get some advantage from two different providers being competitive, wanting to retain business, which isn't a bad thing.
That's right. So with that, we'll go ahead and move on. Now that we've talked a little bit about selection of service providers, with our last component for today, which is fiduciary liability and insurance, but also two sources of liability, which is the cause of why you want this insurance. So what are the two sources of liability? Again, we talked about under ERISA Section 404, there's certain things you must do. Under ERISA Section 406, there's certain things you're not allowed to do. And under Section 408, there are exceptions to the rules. In other words, what I mean by that is Section 406 says you can't do these certain things, except for if there's what's called a prohibited transaction exemption. So there are certain things that the Department of Labor has said, hey, these exemptions, it's okay. You can do these things because we have an exemption to that prohibited transaction that we told you couldn't do. So a good example of that actually is paying for service providers out of plan assets. Technically, that's called a prohibited transaction under Section 406, but the exemption to that or exception to that rule is you can do that so long as the compensation is reasonable under Section 408. So that's the exemption. When you have a prohibited transaction and no associated exemption, then you have a problem. Now, you can have a prohibited transaction both if you're a plan sponsor. Plan sponsors can have prohibited transactions, as well as if you are a service provider. And so plan sponsors need to be aware of both of those. An example on the plan sponsor side would be if you take a loan from participants, that's a prohibited transaction. Now, an example of a loan from participants you might not be thinking about would be if you are late with your employee contributions getting over to the trust, then that is actually an example of taking a loan from participants, which constitutes a prohibited transaction for which you would need to correct. Now, corrections can be anything from, some sort of just nominal put the participant back in the place they would have had the error not occurred, plus then some sort of like lost earnings or excise tax, to they can be pretty major in terms of if you have a breach of fiduciary duty and there is a lawsuit against you because of it, then that can be a pretty major thing. You can also end up, so there's both criminal and civil penalties, and you can end up with your own personal assets being subject to liability, like your own 401k or 403b plan, if you've had breach of fiduciary duty issues. That is very rare in circumstance. So again, we're not going down the scare tactic route here. But when we are thinking of breach of fiduciary duty, we do want to make sure that we're thinking about how to protect ourselves. So many of the things we've talked about today are very helpful in protecting yourself when acting as a fiduciary. You can also consider, number one, you are required to have the bond by having a plan. So Section 412 of ERISA says you must have a bond for all plans. But there's something much better that you should consider that you're not required to have, which is fiduciary liability coverage. I am not a salesperson for fiduciary liability coverage, but I do think, and I get no commission for it, but I do think that it is a good idea to check and see if you are able to have fiduciary liability coverage, because again, it's optional, it's not required, but your normal like D&O or E&O is not going to cover you for most actions related to the retirement plan. With that, Kyle, I'll pause and we'll talk about maybe some wrap up items thereafter. Anything that I missed from a liability or insurance perspective?
Nothing I can think of, Bonnie.
All right. Well, with that, as we close out at the top of the hour, I would encourage folks to add their Q&A to the Q&A portion, and we're happy to take those. We would also encourage you, we've talked about a lot of things related to documentation today, selection and monitoring of service providers, but to break it down into really 4 simple steps, the first thing to really consider is to continue to have ongoing fiduciary training. We really covered just some very modest basics today. If you stick with Kyle and the team, every quarter there's a new topic and we build on this curriculum. We do come back to this basic presentation from time to time, but we continue to build on it with varying aspects of your fiduciary duty. The next thing to consider is to implement an ongoing governance calendar. As Kyle mentioned earlier, when we were talking about forfeitures, it can be very, very helpful to think about how can we, take like that wheel or circle I showed you, how do we put all those different things we have to do into more of a calendar so that we're coming back to this on a recurring basis. The third takeaway I would mention is consider roles and responsibility, both internally and externally. Think about who's responsible for what. It doesn't matter if we're talking about notices or the plan doc, make sure you understand what your respective roles and responsibilities are. And then finally, on an ongoing basis, make sure you're meeting to review progress related to those roles and responsibilities that have been assigned and documenting that progress. With that, I'll go ahead and turn it back over to Kyle. I know we do have the CE credit, which will be sent out to everyone following today's presentation, but I'll turn it over to Kyle to really wrap us up today.
Awesome. Well, thanks, Bonnie. And I tell you this all the time, anytime I either watch or join you on one of these workshops, I always learn something. So I appreciate it because now I'll get to go back to my next committee meetings and sound really smart, at least until I forget it or until the regulations change.